Let's talk markets now as investors prep for the last week of trading in August, if you can believe it. Joining us now, Anastasia Amoroso, Chief Investment Strategist at iCapital. Anastasia, we're coming off of Jackson Hole. We've got PCE this week, NVIDIA this week. How are you thinking about portfolio allocation?
Sure. Well, good to see you, Leslie. I mean, I think coming into this week, especially after Jackson Hole last week, investors should come with a sense of, I would say, renewed optimism, renewed conviction, renewed confidence. You know, the setup for the market right now is quite constructive because we now have this certainty, relative certainty, I should say, that the rates are being cut starting in September. And at the same time, we have this renewed conviction in the economy as well, which looked like or was feared that was going to have a hard landing earlier in August. But now I think we're squarely headed for a soft landing once again. So that's a constructive backdrop for stocks for sure. And, you know, the fact that we're not just talking about a rate cut, but a rate cutting cycle historically supported stocks in a non-recessionary scenario. On average, stocks rallied about 15% after that first rate cut. So that's why I suspect we're going to continue to have this positive sentiment to the markets in the coming week.
What do you think all this means for capital markets activities? I know you're also focused on the private markets, and you would think with the broadening out of the rally, bringing small and mid-cap stocks up along with it, as well as the potential for a rate cutting cycle, that would bode well for things like IPOs and additional capital markets activity. Is this kind of the catalyst that CEOs and the C-suite was looking for?
Yeah, I think that's exactly right. I mean, this is very constructive for capital markets activity. And Leslie, to your point, when we look at certain measures like the IPO barometer, that's been ticking up for a number of quarters, actually. But the IPO activity has been slow to follow, but it is starting to follow through. And also, we have seen an uptick in M&A activity, and much more is expected in the second half of the year. So I think the missing piece, to your point, was exactly this, is this definition and certainty of where interest rates are going, which therefore would support valuation around a certain level. So I do suspect we're going to see a pickup there. And look, fundamentally, taking a step back, it's not just about a boost in sentiment from rate cuts, but it's also about the boost to economic activity. You know, one of the things that has been lacking, for example, any sort of interest rate sensitive sectors, whether it's car purchases or home purchases or just loan growth, that has been very, very slow. But if you look at the SOFR rates and some of the commercial loans and industrial loans that are based off of those, the fact that they're now resetting lower as we speak, that's very constructive. So I think that's what the CEOs are going to be looking for, is better financing conditions, mean better fundamentals for those companies, and therefore they can do much better in capital markets.
Does that suggest to you, though, that perhaps the market is already priced in and consumers and businesses have already kind of capitalized on the benefit of lower rates, that when it ultimately, if it does happen in September, may not be as much of a market moving event because so much of it's been priced in and so much of the behavior has already been effectualized?
Yeah, I think it's a great question, Leslie. And I think we have to decouple the market reaction with the economic reaction and the market reaction to that economy over time. So I think near term, I would agree, you know, the fact that the Fed is going to cut rates in September, that certainly came as no surprise to the bond markets, for example, which certainly priced in not one, not two, but 4 rate cuts by the end of the year. So that's not a surprise. So therefore, when the Fed ultimately delivers, maybe the market reaction, you know, stock reaction is somewhat muted. But the fact that consumers and corporations are going to start feeling the loan reset, that doesn't occur overnight. That occurs over time. It occurs with some sort of a lag. So I suspect in the coming quarters is when we really will still continue to feel the benefit of rates that are being lowered. And if that's the case, that should provide support to the economy, and over time should also provide support to earnings. So I think that's why, Leslie, you know, the market historically resumed an upward trajectory, is because the economy responded to those rate cuts.
And that's why a lot of investors have been allocating more toward banks, more toward real estate. I know you're kind of in that camp as well.
That's right. That's right. We've been in this sort of barbell approach camp, meaning you should, well, first of all, you should have allocation to broader equities. But beyond that, you should probably have some allocation to defensive sectors like utilities, because it actually do tend to do well around these pivot points in interest rate policy. But the other part of that barbell has been the basket of rotation trades, which of course includes real estate on the public side and the private side. It includes regional banks that are highly levered to the improvement in commercial real estate, of course. And, it could also include things like small caps. And if you look at that basket of rotation trades, they fared really well despite the pullback. But due to the bounce back, they fared well since the beginning of July. But I would also add, to that sort of extended barbell approach, I would also add semiconductors. And of course, with NVIDIA reporting this week as well, semiconductors, by the way, they've snapped back, but they're still trading above 10% below that all-time high. And semiconductors being cyclical, being AI driven, I think continues to be a good place for investors as well. So there's a lot to do in this market right now.